and welcome to the Investing Master Series. My name is James Boyd. Today's date, October 21st. Here we are on Tuesday as precious metals, or maybe not so precious. We'll talk about that here today. There's been some questions on that, so we want to get to that. We did have an interesting discussion on that on Friday, talking about ATR percentage. We'll actually address that right off the beginning. We also have with us Barbara Armstrong in the chat. We welcome her back from that Canadian Thanksgiving. Hopefully that tastes as good as you thought it was going to. And also we got Dom, Jim, Bill, Willie, Fayez, Grace, Jump in Joe A, and many others. Welcome to all. Now just remember, Barbara and myself, all of us coaches, we do post educational content on X. There's my handle. Barbara will post her handle in the chat. Barbara is actually here, so that way I'm going to be teaching. Barb's going to be watching, as should be kind of answering some, you have some questions. You type those in the chat. Barb's going to be manning the chats full time, okay? But I'll also be looking at the chats as well. So just know that two of us will be working the chats. Now, quick reminder, we also did have Silas actually mention that, hey, he is watching this class from his phone. Yeah, I mean, you could just pull up YouTube on your phone and you could just see the class. If I pull it up right here, there it is right there. I'm just watching it on my phone, okay? Now, the nice thing is, I'll admit, I carry around with me a man purse. My wife makes fun of me. I like to bring my iPad. And if I just pull up this as well, I could just go to YouTube right on my iPad, click on that Investing Master Series, right there. And that guy looks pretty familiar. And there it is. So don't think that you have to always be sitting there at your computer watching it. A lot of you like to go in the backyard or wherever and just kind of, we have these mobile devices, and why not actually use them? So you can follow us on mobile as well. And so it's great, Silas, that you're with us on the phone. Now, just real quick as we get going here today, we'll talk about stocks and options. We're going to talk about, as Bill would say, the administration of the portfolio. We need to talk about some stock positions. There's one position I don't really like right now from a technical standpoint. I need to ask you a question if the paper money account should sell it, okay? And then we're talking about maybe some ones, maybe should we hold them in the paper money account as examples? What do you think we should do? And this is where it really kind of comes back to the rule set and trading really what we see on the charts itself, and having kind of a system or rule-based plan that we're following. Now, remember when we talk about options, remember that options carry a high level of risk, not suitable for all investors. When we talk about the information, it's provided for general informational purposes only. Also, when we talk about examples, we will be doing those on the paper money software application. Paper money is really valuable just because it allows you to really learn and see if you understand it. You want to say, can I make money in paper money? Do I understand how it actually works before maybe considering it live? That's up to you if you wanted to do that. And also remember that investing involves risk, including loss of principal. Now, also remember that short options, those could be assigned at any time prior to expiration, especially as we talk about cash secured puts, which we did yesterday. And also remember that all examples are just that. Now, we'll talk about market conditions. When we talk about market conditions, the theses I want to pull out, it's not thesis, it's theses. We want to ask the question, is a sell-off in precious metals a good thing for equity markets? And I'd like to know everyone's answer to that. Do you think the sell-off in gold and silver, okay, is a good thing for equity markets? In other words, the money goes somewhere. If you sell out of gold and silver, could that actually cause maybe some other areas to go up as they reinvest some of those proceeds? You sure hope so. Now, some people might say, James, if someone couldn't make money in gold and silver in the last 30 days, maybe hang it up, okay? In the paper money account, I'm saying in the paper money account, because my gosh, I mean, that went up about as straight up as you could get for about 30 days. There is always the person who bought the very tippy top who feels like after 30 days they finally get in and now it went down, okay? I think all of us have been there. So you can lose even in something that actually still goes up if you buy it at the top. That is true. Now, also remember, we'll talk about some strategies that we need to address in terms of stocks, verticals, and a caller example. Now, what I'm going to do is let's pull up just real quick a couple charts before we actually get going. I want to pull up the VIX. This has really kind of been something that we've wanted to kind of keep an eye on. Now remember, We talked about it last time. When the VIX is up, people's emotions are up. The problem is with investing is it's usually the opposite of your emotions. So when the VIX is high, the natural tendency is you want to sell and just get rid of it, minimize my pain. But that actually might be the best time to buy potentially. Now, you don't normally see that we go outside the bands. You can. The farther we are above or below, the greater likelihood that it snaps back into the middle of the range. VIX falling down a little bit. So what does that tell us about equities, markets? They're probably slightly bullish or bullish, okay? Now, pull up the S&P 500. When we look at the S&P 500, let's play a little game called Tell Me What You See. Well, if we take a look at this, remember, we've been kind of talking about this 10-10 open price, not to beat the dead horse here, but if you just kind of take a look at that, that kind of looks like we're poking our nose above that 10-10 open price. I've said to you for weeks now, be very careful who you listen to in the market. Be very careful, okay? Everyone's entitled to an opinion, but it doesn't mean it's right. It doesn't mean it's backed up with experience. It doesn't mean it's actually has any, how good has it been over time in looking at that opinion, okay? S&P, now this is what we said. This is the question we said. Is the sell-off in gold and silver good for the equity markets? My answer to that is, I think that could be some underpinnings to having the market get above this open price and maybe even take out the prior high of 67, 64. I can hear Lisa say from your mouth to someone's ears. Okay, yeah, I don't know if she would say that like she did before, but I got a feeling. So the S&P, now what does that tell us about sectors? It tells us probably the majority of the sectors are going up, okay? Now remember, if we're talking about things going up on the S&P, your growth areas are probably actually going up. Now, if we look at the NASDAQ just real quick, pull that up just briefly. If you look at the NASDAQ, that's the one that was leading with the Dow Jones yesterday. You're going to see that yesterday we closed above it. Today we go down to the midsection of the previous day. My gosh, we've seen that thousands of times. And then people would view that as weakness. That's not weakness. This is first support area number one, and you've already seen a mid-morning bounce. Now, if you take a look at that, could that be a hammer if you think we're making a higher low? It could be. If you think this is actually resistance, you think it's a hanging man. If you are bullish, you're thinking that is a bounce intraday off yesterday's midsection, which can act like support. This is also kind of showing, if you look at the Dow Jones itself, what does this look like? Be very careful who you listen to. And I'll be honest with you, I'm just going to tell you the way it is. There's a lot of people talk about the stock market. I'm not really interested in hearing what they say because I've listened to them for 25 years, and I'm talking about people outside. Okay, in my outside world, they don't really have a ton of experience. They really don't. Okay, and everyone's entitled to learn, but I don't listen to what they say. I mean, I don't take it internally. I listen to what they say, but I don't internalize it. And the biggest thing about investing is you can listen to other people, but you got to be very careful of internalizing, because when you internalize, then you trade like that. Then you invest like that. That's a very important lesson. Okay. Now, when you take a look at the Dow Jones itself, let's just all say together on three, brand new high on the Dow Jones. Now, that kind of tells us what is actually leading on the Dow Jones. Well, you tell me, what is leading? What's getting a little push? Now, I did post something on X today that I thought actually took some interest in. And, if you go back to really kind of seeing the share of largest sector in the U.S., it used to be back historically, those financials and real estate. Then it became transports in late 1800s. Then it was energy and materials in like 1900 to 1950. But in the last number of years, probably in the last 30 years, the bulk of the largest sector in the S&P is really technology, and technology, okay? So becoming familiar with technology companies is big because that's really what's really driving a lot of prices or index levels or sectors or industry groups hitting brand new highs. Now, if we were to ask ourselves what is kind of standing out here on the Dow Jones just real quick, I pulled this up and said, what is getting a little push here? Now, I'm getting some comments that Amazon is actually hitting some highs. Now, we've all heard the joke before where the Amazon driver knocks on your door and says, hey, I just want to make sure everything is okay. I have not been to your house like I am every day. Just want to make sure you're doing okay. Yeah. Yeah, I know. But Amazon is getting a little push. Where is Apple? Apple's right there. It's only up $1. I know we want the pay money. The investor out there wants 10, but that was a brand new high. We can see that doink, hold right there. That was a brand new high yesterday. Okay, but if we said, is anything actually really hitting a 20-day high or 50-day high? Answer is Triple M had a big move. There's a 20-day high and a 55-day high. 20-day high for 1 month, 55 for 2.5 months. 20-day high for short term, okay? 55 getting a little bit more intermediate. CRM is also doing that. You also see Coca-Cola is getting a push. The other one that's getting a little push is AXP, which really shouldn't surprise you because, well, stock's been going up for a while, okay? That's not one like Apple where it's just now starting to go up. That has been going to the upside. Now, I'll come back to that, or at least a space in just a second. When you look at what Apple looks like and say, what does Apple look like? Whenever we get like a breakout to a new high, and I repeat myself, I know this, but it's usually the second day that is the high, typically. And then what? What tends to happen after that second day of the breakout? Well, you shift from a higher high to maybe like a higher, come on, help me out here. I can't do everything. Yeah, that's exactly right. A higher low. So if you said, look, I'm going to try to get in on the shift from the higher high to the higher low, you might be saying, James, I'm trying to maybe set like a buy limit order and try to buy in on that bounce. Some of you actually might say, look, I'm going to set an alert. And I'm going to set the alert. If we pull back to where this old breakout was, let me know because I manually want to put in the order. This is not an order to get in. It's what it sounds like. It's an alert, okay? So if this pulls back in the short term, people that are probably struggle with technical analysis think that's bearish. You got to remember, if you make a higher high, the highest likelihood is to make a higher low. That means it pulls back. Pulls back does not mean bearish, okay? Pulls back does not mean a bear market on Apple. You need the pullback to make the higher low and or support. It's a part of the uptrend. Exhaling is a part of breathing. And so you need the exhale in the price to make the higher low and or support and allow other investors to come aboard the trend train. Okay? The trend train, just to be clear. Now, I want to also pull up just real quick kind of the theses of what we talked about initially, which is, could the pullback in gold be a good thing? I'm going to throw it out here. I think it could be. Okay, we'll find out. But the point I want to kind of really bring up in this is as we kept going up higher and higher and higher, the range was getting up higher and higher. Well, obviously, because if you get a higher price, the candles tend to become, the range becomes bigger because the price is bigger. What we said on Friday is that if you actually, for example, see the ATR, which is expressed in dollar terms, but if you look at the ATR expressed in ATR percentage, and that ATR percentage is the same idea, but just not looking at dollars, it's just saying what is the range divided by the price. And the higher the percent becomes, the stock trend really becomes like Jenga. It's like that little game where you stack a block on top. You take one off the bottom and then you put one on top. You take one off that bottom third and you put it on top. You take one off the middle and you put it on top. And as you go up higher and higher in the trend, there becomes some top heaviness in the price. And then all of a sudden what happens? the ATR percentage gets astronomical like it was on Friday, and then you say, Jenga, okay, it falls down. And so this is kind of the shakeout. Now, last week we really kind of talked about, let's talk about this first trade example on, what is it, NEM? Let's go pull it up. Now, by the way, this move that we're seeing in gold, it's not just gold, it's silver too. And you probably think that silver would be worse, and you see that it's kind of accelerated. Now, if we go back to say what was the position, let's show it. Now, our example was, we've been kind of the last 10 days or so, we've been talking about collars. Legging in the collars, which means the investor already has the shares already. 2, that the investor maybe just does a buy right collar, okay, where they buy the shares and they sell the call and buy the put all at the same time. This trade is vertical-like, okay, because it has a cap and there's a floor. The difference between a vertical, like a long call vertical, short put vertical, versus this collar is the investor has the shares. But the risk profile diagram looks very similar, okay? Now, what you're now going to notice is, can anyone actually, so if we looked at the stock price, the entry of this was 89.25. Okay, fine. Now the stock price is at 85.94. Okay, fine. And now we see, oh my gosh, we're down $328. That trade was put on 8 days ago. Now, let's go back to something for just a second. We know that if we look down below, we sold the call. And when did we sell that call? The exact same time that we bought the shares. Okay? Now, I'm just double checking. When did we buy the put? The exact same time. So this was a buy right collar. Now, we got to ask this question, okay? Is a collar position, is it a bullish strategy? And the simple answer to that is, if you own the shares and you actually have a positive delta position, it is a bullish strategy. Okay? Now, we know that, for example, if you said, okay, let's look at the number of shares. Okay, just want to make sure we're clear on this. The number of shares times the stock price movement times stock price movement, okay, equals, all right, in terms of dollar amount, are you up or down? All right. Now, if I said, hey, we got 100 shares and the stock price is down $2, nobody would say, I don't get it. I know I'm down $200. Well, obviously, because I had 100 shares and the stock went down $2. Obviously. But we don't have shares by itself. Instead of saying the number of shares, I'm just going to say, we're going to translate that to delta. Okay, so delta, I'm just going to type in 27. And what we're going to do is we're going to say same thing, times the stock price movement. Well, the stock price movement was $9.02. Stock movement. Okay, I'll just say stock movement, and that's going to be $9. That's a negative $9. So now what you're going to see is, if we said, well, how much did this lose today from yesterday's close? Answer, it's down $243 since yesterday, okay? So when we look at, let's say, if we're talking about stock, we're looking at the number of shares. Okay, fine. But if we're looking at options, we're converting to get the profit or loss amount. Instead of shares, we're saying delta. Okay, that's the conversion. And so now on this position, how do we manage the position? So first off, before I even go look at anything, I want to see, well, how many days do we have to expiration? 31. Why is that so important? Well, because if we have more than 4 to 10 days expiration, we're not going to sell the long put. We are not going to sell the long put. Why? Because that long put is giving us some time. Okay? If we were inside 4 to 10 days to expiration, could we sell the put? Yeah, we could try to. Obviously, you try to buy or sell anything, you check liquidity, okay? You can't just assume that it's liquid, okay? Liquidity changes. If I wanted to sell this put, if I did, all I got to do is right click, create closing order, and sell. And if we did that, we'd be trying to grab the $115 gain, $115 higher, $1.15 higher than what we bought it for. Now, are we going to touch that? Absolutely not. That is what's creating the maximum loss that's built in. The only side of the trade that the paper money account cares for is really, do we need to roll the call? Now, when you roll the call, you roll the put, we always talk about, did we get 50%? Did we get 65%? Did we get 80%? And if I go over here to the right, I'm not even at 50% yet. So what is this leading us to think? Well, it's led us to think that we don't really have anything to do. We're not on the doorstep of expiration, 4 to 10 days expiration. We're not selling the put, we're not selling the shares. We're not buying the call back. We're not out of time. And then step 2 is when I come down to the call piece and say, can I roll it? And the answer is, don't have enough premium yet. Sold it for $340, it's at $212. Now, could we set up a buyback order? Could I actually say, look, if it goes to $170, which would be 50% of the premium, could I try to buy it back? I'm okay with that. But the one thing you got to remember is, what happens if there's a wide bid-ask spread there, which it can. Okay, I want to throw this out. I would rather just look at it and kind of say, can we buy it back for $1.70? Since we're talking about buying it back and it would lock in a gain, okay, that's a little different than if we sold the put and we had a conditional order. We're going to say, look, if we can buy it back for $170, that is half of what we sold it for. Is everyone with me? If you sell an option for $340 and then you buy it back for $1.70, what are you trying to do? You're trying to grab half of it. Okay? Now, does that include the commission? No. That commission is right there, 65 cents on top. What we're now going to do is confirm and send. Now, what type of order is this? It's a limit order. Then that means what? That means you're willing to buy it back for $1.70, but no more. Could be that price or less. And it's not just for the day, it's GTC. So notice the clarity of thought here. It's not like, oh my God, it's going down. No. That's what the collar's there for. The collar is actually that long put. And again, I'll go back to it. Lots of people have opinions. Not interested in opinions, okay? Opinions can be right or wrong. We have no clue. Go back to strategy. Go back to discipline. Go back to rule sets. That long put, which most people probably don't really buy, do they? Do they? Okay, now not everyone. Okay, there's people that might consider educationally, but never consider in the real world. Fine, so they have an opinion. But for the people that buy the put, that actually do that historically or now, or whoever they are, that long put, it's interesting. Now the long put, you got to pay for it. It doesn't last forever, but it is a right to sell those shares at 85. Now, why would you want to sell that? A, we've run out of time, or 2, the stock price, and this is a very important point. Let's say the stock just keeps tanking and it goes down to 70, okay? So this is the stock price, and this is the option OX, the option strike. And so I got to ask you a question. When would the investor want to sell the put? Well, if the stock was at 70 and the long put strike was at 85, would you rather sell the stock at 70 or would you rather sell at 85? You'd rather sell at 85. Well, why would you rather sell at 85? It's higher than 70, and there's intrinsic value on that option that's making it valuable. So the reason why people want to exit the long puts typically is because there's intrinsic value, which means the stock is below that strike, and there is volatility pumping up the option price. And if that stock actually tanks from 86 down to 85, 75, give me a 70. All of a sudden you get the intrinsic value and the volatility to go up. And that 85 becomes, it's like a life jacket. It's kind of holding in the losses. The losses aren't as bad because the put is offsetting not all, but some of those losses. The purpose of the call again was to help pay for the put. All right, now, so just for a second, let's say the paper money account that they could lose $750. Does the paper money account have to sell this position? No. Why? Well, because we're down $93. Down 93 bucks. So if we're down $93 now, and we said on this one, now this is double option jeopardy. Okay. So if we're down $93 now, and we can only have a loss of $750, can anyone tell me how many dollars down more can we take? If you get this, I would like to send you out a prize, but I can't. So I'm just going to send you out just like a well done. So first off, if we said, well, how much more can we lose? Okay, answer. How much more can we lose? 750 minus 93. We can lose another $657. That's how much more we could lose. That's just the difference. The question now becomes is, well, what's the delta? Answer, it's about, let's just say 28. It's 28.7 right there. I rounded to 28. And how many more dollars could actually go down before we hit the 750 loss? The answer, if you get this, I'm telling you, you're a sharp cookie. The answer is, how much? 23. The stock could go down another $23, and then we would finally have to say uncle, because the losses on this position would be right around 750. Now, is that actual? Could it be a little earlier or later? Yeah, sure. Okay. So we have a loss right now of about 90 bucks. The paper money account cannot lose more than 750, which means we have a risk budget of 657. That's how much more we could lose. The delta in the position is 28. So if I take what I could lose more, the risk budget, divided by the delta, 28, the stock could actually go down $23 more, and then the paper money account would have to say uncle. Okay? Now, one thing that's kind of interesting about these positions is that means they would, statistically, the likelihood of this is going to go from 85 down to 63, statistically, that's not very high. Okay? Could it happen? You better believe it. Okay? But I want to kind of dive into this because this is what these positions are really meant for, but then also understanding the rule set of those and kind of also understanding, well, how much more pressure can it take? And I'm telling you, the average investor doesn't understand this. The thing is, how much pressure can you take without tapping out? Tapping out is actually where the max loss becomes an issue, and you've hit the threshold. So that's what's kind of interesting. Okay. All right. Now let's go back to, I know, those are just really interesting. Those are really interesting. I admit. And now what I want to do is spend the next 17 or so minutes talking about some new examples. Okay. Now here's what's fun. The more you do those callers, my gosh, it just like with any strategy, it kind of almost becomes second nature. Okay. The things that I've learned to kind of adapt to over time is that I always used to look at callers as a leg-in strategy, but it could also be a buy-right caller strategy too. Okay. And that's just something that I kind of learned over time as well to consider. And that's what our example was. Now I want to kind of fast fire around a couple positions that we might look at. Now, first off, I want to go back to this Apple position. One of the things that we kind of might want to make reference is sometimes not everyone is going to be watching the markets as closely as other people. Fine. And sometimes people might say, well, James, we are at 263. If it went down to 258, I'd like to get in. Yeah, sure. We got earnings coming up right there on 10/30. So that's going to be in about 9 trading days. Now, the reason why I kind of pull this up is when you have earnings, what should the implied volatility be doing? What should it be doing right now? And what does this have to do with investing at all? Well, I want you to imagine that I have like a little canister here that has helium, okay? And I grab a balloon and I kind of go to the nozzle there and it's blowing up the balloon. Well, what you're now going to notice is once we get about 30 to 40 trading days to earnings, the implied volatility, even though the stock was going up, the volatility was going up, blowing up the balloon. Okay? Now, what this kind of does is it kind of allows for something interesting. It allows that the investor could go down and look at those short put strikes, and they might say, geez, with a higher implied volatility, could actually sell a lower strike and still get maybe some premium. Now, if we go look at, let's say, which ones has a delta between 30 and 40? You got the 260, the 257.5, the 255, and you got, let's say, even I'll take the 252.5 or the 250. So now, for some investors, they might say, James, I like to see at least an ROR, premium divided by stock price, of 1.5%. This has 1.44%. If we look at, let's say, the 252.5, that is that's a 28 delta, lower than normal. This is what I'm kind of saying. The higher the implied volatility is, the investor could sell a lower strike. Why is that of interest? Well, if you sell a lower strike, it has a lower statistical chance of being below the strike price. Okay? Now, if you take a look at this, does it have liquidity as of right now? 813 contracts in the world, bid-ask spread 10 cents. Is it liquid? I think we could say it's fairly liquid. Okay? We just want to make sure that we're not looking at something like 36 contracts. I mean, how do I know that it's not just VIC doing all 36? Okay? So what I'm going to do is I'm going to right click on that 252.5, sell. Now here's what's kind of nice about the verticals is we don't have to be like perfect timing, like just nail the timing. If every dollar matters on a stock position, every dollar matters on a long call position, every dollar matters on a long synthetic because the delta's higher. Okay? And that the lower the delta, you could be a little early. And it doesn't have a significant effect because the delta is less. It's a little bit more forgiving. It doesn't mean that it can't lose. It just, the timing isn't as doesn't need to be as spot on as to a higher delta strategy like stock, long call, long synthetic. We're going to sell vertical. And now what we're going to do is we're going to sell the 252.5. And then what we're going to ask ourselves is, do you want this to be like a regular vertical? Or do you want this to kind of more be like a cash secured put? Answer to that is, well, are you trying to play the volatility drop? And if the answer is I'm trying to play the volatility drop, the investor might widen out the spread. If we went down to say a delta 10 or less, here, okay, we might say, you know, James, I'm going to get maybe buy the 250s. So when you widen those out, it's really going to make that where you still are short volatility. If you're short volatility, you want the volatility to contract. Okay? Now what we're going to do in this case, confirm and send. Trade number one here, we're going to do a short wide spread, which is like saying it's a cash secured put with downside protection. The protection is the right to sell the shares at 230. Okay? Now, this type of strategy is probably most applicable, not always, to the IRA, where if you sold the put by itself in an IRA, they're going to want you to set aside 100% of what the max loss could be. Now, so that's, do we have to do them in the margin account? Don't have to. Don't have the same requirements to set the capital aside like in an IRA. You'll see the difference. We're going to go ahead and send the order. So trade number one was a cash secured put with downside protection on Apple. Now, the other one I want to kind of go back to just real quick is I want to kind of look at a couple stocks that might be getting a little move. Now, we pulled up AXP before. AXP pushes to a brand new high. Now, if we said, well, is it just AXP Or, okay, or is it in this case, is there other stocks in an industry group that are actually high as well? Well, I mean, you don't probably need to run a search. You can think just, well, where's Visa? Okay. Visa is not at a high. Okay. Is Visa breaking out? I don't see a breakout per se. Short-term diagonal, maybe. Horizontal breakout, no. What about MasterCard? Kind of more of like a diagonal channel. Travelers is another one of those. That's actually been going down lately. DFS, Discover, is that a breakout? Now, at least Discover has an upward trend to it right at the prior high, and I'm missing one. COF. Now, I'm going to kind of bring up the example of COF for just a second, because if we looked at COF, that's kind of had in the shorter term like a little double bottom, 1, 2, and we want to ask ourselves, have we gotten past the earnings? It is after the market today. Now, the expectation of earnings, 419. I want to look at this example because speaking of the implied volatility is high. The implied volatility right now is at 40. Now, whenever the implied volatility is high, in our examples, we're going to try to sell farther out of the money put. So I'm going to go back into what we just did, but I'll do it a little faster. And then there was a question. So if we go take a look at this, we're going to go look at, let's say, I'm going to look at the ROR. Okay, think of the ROR as the option premium divided by the stock price. Okay, you can think of the ROR like a dividend yield, but we're not talking about the dividend. We're talking about an option premium. Option premium divided in the stock price. You can think of it like that. Now, if I went down and said which one has maybe an ROR of greater than 1.5%, well, it's going to be the 197.5. If we went kind of where there is more liquidity, it's going to be on the 200s. Now, the first thing you notice here is the spread's wider. It's 40 cents. So if we did this trade, probably want to try to do it right in the middle at 350. Might be harder to get a fill. So what I'm going to do, and the question was, why would you do a trade when the ROR, I should say you have more risk than reward? First of all, if you see that, what is that telling us? What is that telling us? Now, I'm going to set this trade up exactly like the other one, and I'm going to try to do this trade at the 185. I'll wind this out, not as much as the other one. So if we look at this trade, the credit is 215, okay? Now, if it went to zero, now, when I say that, if it went to a max loss of 1285, what does that tell us? That means that the stock at expiration is below both strikes. Well, what person would do a trade when the profit is so low relative to the max loss? Well, so first off, that max profit versus max loss does not tell you just by looking at those numbers what the probability is. If we said, hey, what's the likelihood of the stock being above 200? Let's go back and double check. Well, if we actually said the likelihood of the stock being, well, let's start with below first. The likelihood of being below 200 is 22% at expiration. How much below? At least a penny, okay? Now, what's the likelihood of being above 200? Well, 100% less 22% gives us 78%. So we actually go back to this and said, well, what's the likelihood of actually getting 215? 78% chance. Now, if we went down and said, what's the likelihood of being below 185 at expiration? Because I'm looking at this max loss, I would never do a trade like that until you understood the probability. Well, if we went back to that probability and said 185, what's statistically the chances right now of actually being, let's say, below that strike price? Well, there's a 9% chance of actually hitting the max loss of 1285. So be careful when you just look at the numbers and say, I would never do it, because you're risking a whole lot. Those numbers are telling you something about probabilities. Now, the comment from Mari Bearns is, are we picking up nickels in front of bulldozers? Now, I challenge you this. If you ever went downtown in any major city and you looked up at those large buildings, who are the people that are on the sides of the buildings? What names are they? Are they picking up nickels in front of bulldozers? How they get in the big building? Does it mean that they win all the time? Of course they don't win all the time. If we actually said Warren Buffett, does, for example, one of the business he owns, Geico, does he pick up nickels in front of bulldozers? Yeah. Okay. But the thing is, he's using probability, fully understanding that sometimes they will be on the wrong side of the trade, but it is a defined risk, and I'm talking about this vertical. So be very careful and kind of like, you need to see the context, see the math behind the trade, okay, and understand the strategy. Now, what I'm going to do in this case is we're going to send that. So down COF, that's the second trade. So trade number one was Apple, okay, and the plan is to go over earnings. Same thing with COF, obviously, because we're on the doorstep of earnings. The one thing we're trying to make sure with COF is that this trade fills, okay? Now, what I want to kind of do in this case is if I went back to, let's say, a couple other stocks that we're going to keep an eye on. Well, the stock that we're going to keep an eye on is so if we look at this, I'm going to go back to, let's say, the example here. We're going to bring up Meta. And if we take a look at Meta, one of the ones that we're going to pull up, Meta, we're going to pull that up. And the one that we're just going to kind of keep an eye on to see if it can't get a little reversal, Meta. This one came up today, did not break through this old support, new potential resistance. We're going to keep an eye on that. The other one that actually got a pretty decent push today that we're going to keep an eye on, remember, we're going back to, let's say, transports. Why are we talking about transports? Remember, if you're in the transport business, every day, typically, you're filling up your vehicles with water. Well, not just water, gas, diesel, okay, natural gas. And if that input cost is dropping, but your order flow is staying the same, you could be a little bit more profitable. Keep an eye on FedEx and UPS. We did see GM today got a big push as well. Okay. Now, a couple other stocks we're just going to keep an eye on with that, speaking of cars. One that's actually rallied back to the upside and created a flag on is Tesla. Now, Tesla is kind of really broken into car price, which many automakers haven't been able to do. If you try to go out there and say, I want to buy a car for $35,000, $3,750 out the door with tax and everything, it's hard to do, okay? Tesla selling their Model Ys and some Model 3s in a lower price point. Could they actually be attracting new buyers that can't find that with regular gas cars? This has also been one that's coming into the earnings on the 22nd. So if we kind of said, is there any strategy emphasis as we go so close to earnings and or over earnings? I think for some investors, they might say, James, short put verticals, probably farther out of the money, are defined risk, okay? So understand that they're not just kind of like risk down to zero, but the investor is trying to use the collapse and volatility. Now, what's amazing about the volatility is even if the stock actually goes down, the volatility typically goes down too. And that's important to remember. So I want to give you a specific homework assignment. You're allowed to pick from 3 different strategies: a cash secured put with downside protection, which we did today, a short put vertical, and or a collar strategy. Those are the 3 strategies that you can choose from. I would like you to look for, let's say, stocks that actually have, let's say, some higher implied volatility and earnings coming up this week or next. And I want you to practice doing those strategies over the earnings. And the goal is to hold over earnings and watch the effect of volatility on the profit or loss. That's what I want you to do. So you get to pick which one do you want to focus on. Could I do 2 or 3 strategies, 2 or 3 stocks with the same strategy? Yes. If you want to kind of practice each one of the strategies on 2 or 3 different stocks, go for it, okay? whatever you want to specialize in. They're similar in nature, but not completely the same. Obviously, the caller owns the shares. Now, I'm out of my time here today. The other thing we want to kind of point out in closing is keep an eye on gold. Does this sell-off lead to equity markets that push to new highs? We're thinking it could, but over time, we will find out, okay? And if we start taking out the open price of the S&P 500, 6740, those bears that got in, they could be starting to get stomped out of those positions. So keep an eye on that. Now, I want to say thanks to Barbara Armstrong for answering those questions in chat. We got Cameron May coming up next. Smash the thumbs up button on this video if you've enjoyed today's session. Nice discussion today on callers with gold movement and also understanding volatility and also getting a homework assignment applicable to what we're actually seeing in the markets. Now, remember with what we discussed here today, it's done for example, illustrative purposes only. Also, don't forget to subscribe to our Trader Talks channel right on YouTube. It's free. And with that said, stay tuned for Cameron May coming up next. Have a great day. Take care. Bye-bye.